The thing that I'm most interested to see unfold in 2024 is what happens with all of the money sitting in cash, in money market funds, in CDs. I think it's $8 trillion. I don't know exactly what the number is. My suspicion is that that is more cash. And so even if interest rates come down, which most people think they're going to, I think that more money is going to stay in money market funds than other people might think. The CFO of BlackRock on their earnings call said he wakes up every morning salivating about all of the money in money market funds because he sees it as a huge opportunity for inflows into fixed income and maybe even equities, maybe risk assets. And I'm sure there will be some of that. There's no doubt about it. But I don't know that it's going to be the tailwind for risk assets that people think. I think 5% is incredibly attractive. Again, even if they're not getting 5%, I think it's money that should not have been in the checking accounts for as long as it was. And then once SVB hit in March and rates, I mean, that really woke people. It's like, wait a minute, I'm getting 4 basis points. I could be getting 3% now. And then once we cross what I think it was 4%, it was just a tidal wave of money in. So I think it's mostly checking account money, but there is an over allocation to cash. On Morgan Stanley's earnings call, they were saying 22 to 23% of their client's money is in cash. That is a lot. And I don't blame anybody for having an overweight position to cash in 2023. The world was a very scary place. Everybody thought we were going to a recession. So I get it. You can get 5%. That's if it's a warm blanket of cash. It feels really good. For the first time in a long time, you're getting real returns in cash. And then what did the stock market do? The S&P 500 was up 26%. The NASDAQ 100 had its best year since 1999, up 56%. And so that you're not getting that back. And so to me, the biggest question for 2024 is what happens with all of the money in money market funds and cities. Advisors and individual investors need to be prepared for a world without 5% cash. Now, again, if this is your checking account money, and instead of getting 5, you're getting 3.5, that's great. But if you took 30% of your fixed income or your equities or whatever, and you move that into money market funds, which, okay, I understand, you need to have a plan. Because what you absolutely cannot do is be surprised if there are rate cuts. And this is a weird paradox that there are going to be people who feel that when the Fed is easing, they're tightening. Because it's, hey, wait a minute. I was getting 5% of my money last year. Now I'm only getting 4%. Why are you taking money away from me? So if you know it's coming, and we don't know where Fed funds are going to end up, but you know it's going to be less than 5%. At least that's what you should expect. So you need to start thinking today about how you're going to get reallocated into, if it is coming out of bonds or equities, today. Not if there's a melt up and you start chasing. Do not do that. So that would be my advice.